My 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, in today's video, we'll discuss exactly what happened today with the final PPI release and what it means going forward and markets reaction. So let's get into today's video. Well, welcome everyone. It was an interesting day again. We saw a bit of volatility. On the S&P, we traded down to 55.40 before rallying back over the 56 handle. And the markets continue to march on. And I mentioned in yesterday that there was a reversal pattern that set up, and we got some follow through today. So we'll talk about that. Let's kind of go into something. I've seen something that I wouldn't call it concerning, right? But what I would call it is that what I'm seeing here is the market's confidence. I read a couple of things to see what some summaries about today was, getting ready for tonight's show, and the folks are gold rallied to a new high. Why did it rally to a new high? Because rates are going to drop. You know, they're trying to front run the rates, and the question is this really all that bullish? What's going on here? And I'm still under the basic opinion that this is really window dressing. If they do anything, I don't see it as being anything big. It's funny because they're talking about rates going lower, but the 10-year actually sold off and was down almost 1%, about 0.75% on the day, while they're talking about lower rates, and lower rates aren't what's happening. So this is part of what I've been talking about. We live in a much different world, folks, from the standpoint of the markets. And I've grown up in these markets, and yeah, I just see something that I think very interesting is that the stampede and the crowd mentality. You know, we can go to the meme stocks, we can go to GME or whatever you want to go with, right? You can see the power of the retail. I was having a little bit of a discussion with a friend the other day, and they were talking about they think retail guys are still out in the way back out of the way, and I actually think retail has become more substantial than we've ever seen it in the past. And just a quick story for this perspective is the reason why I think this is the case is I grew up at a time when I started in the markets in 1979. You got to see what us brokers wanted you to see. So that we controlled all the information. We had the quote screens. You didn't have live quotes out in the public. It was way too expensive back in the day to even think about doing that. And some, obviously, large individual traders probably did that. There's no doubt about that. But there weren't that many of them. Now we all have full access to everything. We have full access to the news, real-time data. I have a service that when things are going on, sometimes it plays real time. Anytime there's news or breaking or anything, they just come up and announce it. And that's nice to have in the background. I actually have it a lot on when I'm writing the Substack newsletter at night. I'll have that on because it's a London broadcast that put out, but they do a good job of just kind of breaking news, things that are happening around the London Open. I find that interesting. But my point is that we all have this unbelievable access to the markets. And not only access, we have the ability in a nanosecond to pick up one of these guys and pick up this mouse and fire away and trade depending on what kind of money you have or what money you don't have. You get fractional shares, all of that. So I don't want to get too deep into this philosophy, but I continue to see something. I think it's becoming more and more evident. I talked about the big reversal, and I call them swarm trading and stampede. We saw a mini stampede, not like as big as yesterday, but we saw some follow through today. And I think the enthusiasm over all these rates being held so high for so long that people are ready to lower rates, yay. But so the question is, and I'll try to unpack this I did a little thought and wrote down some notes about this before we started tonight. But is this really bullish? If the Fed starts incrementally just start clanking down on rates per 25 bips at every meeting, is that really bullish? And I actually don't think that's what's going to happen. I do believe that we could see it, like I said, a decrease next week, and I get everybody's enthusiasm, but it's like it's this front running of the event that's interesting. So it's one of those. There's an old cliche: buy the rumor, sell the fact, right? So what happens a lot of times is market participants will want to anticipate the event, and when the event happens, the market goes down, and that may be what we're seeing here. I'll go through tonight on some of the markets that we're following. We had a big reversal pattern yesterday. We got confirmation higher close today. There's probably more higher prices coming. I mentioned in yesterday before we had the internet glitch that we had, there was new Fibonacci targets, all-time new high targets being forecasted. All kinds of things are out there, and by trade, I am a quant. I am a technician by trade, but I do something I've told you folks about before is this reverse fundamentals. And anyway, this is what I think we're seeing here. We saw like the markets got a little negative today. Actually had best trade on the short side early on in the session. It was awesome, and was able to cover around 40. I think it was 47 when I covered some of the shorts I had on. I had other things going on, didn't get the trade the rest of the day. The big trade was to reverse that trade and just go to lunch and forget it. But the point is that this big volatility, these swings that we're seeing, and they seem to be loaded up one-sided. And I posted in last night's Substack a 15-minute chart. You can see how vertical that move was. And those are the kind of things. I don't think those are normal. Normally, if I'm an Elliott-tician as well, so you'll see patterns where you look like you can see wave patterns. Those straight-up patterns are just they're very difficult from a wave pattern. This old theory. Some of this theory doesn't map out very well anymore, and I've noticed that as well. And there's some new patterns that have emerged. So okay, I think I'm done with that. But let's talk a little bit. The PPI numbers actually were in line. The CPI numbers were in line, maybe a little higher on CPI, and everything went from bearish to bullish really quick. Why? Because those numbers didn't mean anything actually. What people are looking at, as long as there was no big surprise, everybody's looking forward, and this is kind of the point of my opening comments today, is that everybody's looking forward to this event that we're going to see interest rates start to drop. And I've shown you the chart that I've had on many times before, where our algos are forecasting in 2025 at least 100 to 150 basis point drop. And I've been talking about the front end of the curve. The front end of the curve is not the 2-year, by the way. The front end of the curve is the Fed funds and all the T-bills. That's where a lot of money flows through that part of the market. And I think once that cost gets adjusted down, then that will be bullish longer run. So there is a bullish component of this. But is it bullish at the moment? Maybe so. Like I said, I'm going to go with the numbers. Our database has been kind of down ticking. I'm hoping if we're lucky enough and I talk for long enough and we don't get an interrupt on the internet like yesterday, what I'll be able to do is I'll be able to see the database output before we leave here. And I started a little later today trying to overlap that. I think they come out around 5:15 my time, 8:15 New York time. So maybe we can get a look into that, because part of what I want to see is there, even though we had another positive day, did we get any further attrition or selling in our database, which means there are trends failing. We're not looking at simple, very retail ideas like the X amount of stocks over the 100-day or the 200-day or the 50-day. That's all amateur stuff. When you start, the fact that a price is above something doesn't mean anything. And what means something is if you can identify trends, and that's what our database does, and that's why I spend so much time on all my Substacks and when we're going through these live streams talking about the database, because those are trends that are being identified and probabilities that have stacked up. And this is a database that's been running since technically since 1996. And so I've got decades and decades of understanding of this. And I've talked about the whole way that we've unfolded this year has been very different. We've seen more volatility on a short-term database than I think I've seen any other year. And that goes, maybe 2020 was different because that was, everything was so extreme. But it was still one-sided. It was selling and then buying. And this year we've seen selling and buying, and we've seen monster swings between the bullish percent going from as low as 8, I think around 12%, 11 or 12, and as high as almost 90. It was in the 80 handle. So I've not seen those kind of swings, and it's happened multiple times this year. So it's been a very, I think 2024 has been a very emotional year, and it's not going to get any better. You know, we're maybe 60 some days out from the election. There's a lot to go on here. So, but just to kind of summarize from the standpoint of market participants, I think there is a shift in, we'll call it mentality or sentiment shift is different. A lot of ideas of front running, getting in front of things. There's a lot of us trading now. I mean, there's never been this many traders on the planet ever before. You know, in a minute we're going to use TradingView. They've got 60 million users on that platform. So, I mean, there's never been anything like this, folks, and the size of the brokerage firms and what volume goes on the exchanges, never been anything like it. I mentioned, I think, in last night's Substack that when I started in the markets in 1979, 40 million shares was a big day. 40 to 50 million. It was like, wow, that's a monster day. And that's like the first tick on tomorrow's opening. And so things have changed a lot, and I'm just identifying some things that I'm seeing here. Yeah, so let's set up the rest of this video for tonight. So I'm going to go through the indices, and I'll cover gold, because yesterday I touched on gold. It looked like gold was going to stay sideways, and it blows to the top, but we did get an interesting event that happened in gold. So I'll cover gold. I'd like to get through maybe touching on just taking a quick glance at the dollar. So I'm going to try to go fairly quick through these markets. Just a other final comment before we move on. If you notice all the NVIDIA haters, that stock is up almost 16% since last Friday in 1 week. So the volatility, this is kind of what I'm talking about here. They're meme stocks almost. The NVIDIAs, the Teslas, Apple's now like the old IBM almost. And so we'll see if they get a punch. We'll see what kind of numbers they get out of the new iPhones launch, I think at 5 a.m. Pacific time in the morning. So we'll see if they get some kind of jump. But the bottom line is these newer companies, new players that are coming in are also getting the swarm and the stampede trades that come in. So very interesting. If when we look back at just a week ago, it felt very negative. So let's go ahead and see if we can get into, I'll do my best to just kind of flow through the charts. As always, this is unscripted. I'm just going to go through and do the analysis with you. I glanced at some of the setups just to see what was going on in different markets. Crude oil was also interesting today. I did cover that the other day, and it's seeing a bit of a bounce. I think it's bottoming now. So anyway, let's just get into the charts. Let's start off by going into the S&P here. So I've got the E-minis up here on the screen, and we'll see that the red dot forecast is still showing higher prices. I'll put my cursor here. This is where a big reversal happened. We got to follow through. Any of you that know about the the 3-bar trade I talk about. It doesn't matter whether it's an hourly, daily, weekly, monthly chart. They all play out. But when you get a big reversal like that, the next day you have to make a new high, and you have to close higher. You can't make a new low. We did that. Right now, the high was 607, 5607, and if we get above that in today's session, that's fine. We don't have to close higher. We just can't take out yesterday's low, or it would be today's low that we're experiencing since I'm doing this video on Thursday. Yeah, so that low is 5540. I mentioned that number earlier. So the effect is that what the forecast and the algos are telling us is that we're likely to be somewhat positive into next Friday. And so I suspect, just kind of walking back some of the things that I was saying a few minutes ago, is, the Fed event is going to be, I think, fairly, we'll call it dovish, but more bullish than anything. So I think there is going to be, the sentiment is what matters. There's a couple of things that people sometimes make mistakes about, and not understanding the market sentiment and the power of that emotion that flows behind it. And especially, and this is why I set you up with talking about all of the players that are out there now. When we get everybody, kind of thinking the same way, beware, don't get in front of that train, because I really mean this. I've seen plenty of big reversals and stuff over the years, but there is a dynamic that is highly evident. I spend a lot, when I'm trading, I use the order book to trade out of. So I'm watching order flow, and the order flow is just unbelievable that happens. And those that have known me close have been around me trading, that I'm always talking about the liquidity in the order book and the size on the bid ask. It's just phenomenal. And even when we see these big orders come up that are offers or bids out there, they just get eaten up like they're not there. It's amazing, actually, folks. As a guy who's been around this markets for 45 years, I can tell you this is a pretty amazing environment we're in. It can be very treacherous if you get on the wrong side. They'll take all your money. And, so, and if you're trading futures, they might take more than you have. So you never know. But anyway, this forecast here, we're looking at the PPMs. PPM 1, which is the top indicator right here where my cursor is, that is suggesting we're going to see momentum return. In fact, if I come over here, it's suggesting that by the end of next week, we're going to be in trend mode up again. So let's do something here real quick. I want to show you, these dots are fairly small. So I'm going to, you can see them, they're really tiny. I'm going to draw them in just so you'll be able to see them on the screen. And they're right here. There's 3 dots there. And those numbers, yeah, I didn't get, I should have made, let's see, 5943 is the minimum number. The old high is 5721 if I go off memory right. That is right at this high over here. And that's likely to remain the top here. So we're looking at, this range here. The algos are suggesting we're going to come up into this upper range again. I talked about this yesterday a little bit, as what we're really seeing here is this little area here is more of a distribution top. And I have been expecting for a while, let's say going back, I discussed this in Substack. Let me clear out this thing. This thing's getting messy. In Substack, this was that 8-day rally we had. And the idea was we would get this and then maybe another move up, challenge, make an all-time new high. That's not what happened. What we got here was really a distribution, what I would call a distribution top, and it set up something larger. So these dots up here, the WaveTech, in the WaveTech indicator suite, we have this Fibonacci forecast tool. It actually recognizes all the lows, and it automatically forecasts these numbers for you. It's got a pattern recognition algo in there that can mark all the highs and lows. And so it's marked that, and these upper prices that we're looking at here are what's coming out of here. So what this is being projected is where this is the pattern is likely to unfold. And this is going to be fairly static, at least on the NASDAQ. I'll try to touch on the Russell here, so I'm going to just set this up. But this pattern is going to be throughout the relative pattern that we're going to see in all these indexes. And I'll set up an alternative is that this is, but by the way, it's just not going to go straight up here, but it could, because this is the way the markets work, right? So we got this 8-day up distribution, we got a retracement, and let me just clear this out real quick. This number right here was a forecasted number by our WaveTech tool, which was 53.92. I talked about that number for a while because it's been calculating going all the way back to early August. So this number has been calculating, drawing this line here. And I said, that's going to be your pivot. We got down to 94 the other day. On last Friday, we got 53.94 print. Of course, we came in and opened higher on Monday. Haven't looked back yet, right? So we've seen we've got these big reversal day. We had big volatility day a couple of days ago when the CPI came out, and now we're getting follow through. The algos are suggesting we come up in here. What we want to watch, the market grid is likely to kind of flow around this as well. So we're going to end up in getting boxed into this pattern as far as I can see right now. I don't think we just moonshot it here, but it's certainly a possibility. There is a lot of resistance that has been built right in this area here, in this distribution area. So what we'll have to watch for, and the algos are suggesting we're going to go at least through that area, possibility of challenging 57.21, which is the all-time high. The downside is pretty limited here. That we're probably looking at the 10, I'm drawing in the 10 period moving average, the 21 period moving average is in here. Those numbers are 55.78 and 55.38. And we basically printed down to 38 today. It was the low was 55.40. So we basically bounced off of that 10, rebounded, went to a new high, closed higher, and this pattern, at least from a forecast standpoint, and what you're going to see, the algos are suggesting multiple higher closes. Now these will adjust depending on where we close. If we close here, then these dots will come from a higher level. And what my expectation is, doesn't mean I'm going to be right, but my expectation is that we're probably going to start to stall a little bit ahead of the Fed meeting. I don't think it's just everyone's going to front run this thing and put 100% bet that the Fed will drop rates. And then, like I said, even if they do, it's of my theory that it's window dressing. Okay, so let's move on here. Let's go ahead and take a look at the NASDAQ. Like I said, the patterns are a bit more dramatic, but when we look at the algos and everything, they're almost the same patterns on both indices. And in fact, we have this interesting thing, and maybe folks, I'm sorry, it just comes up all the time. I talk about it on the live streams. I talk about it in Substack. The configuration on the NASDAQ always seems to be a little bit ahead. So the PPM2 that's down at these levels here, if you let me draw it in here just so we're all looking at the right spot here. So this PPM2, this here, it's being forecast to be very flat, not really any big momentum up. We're seeing that PPM1 start to accelerate. This is probably the most bullish part of this, is this acceleration on PPM3, because what that's telling us is that this moving average here, this is the 40 up here, it's trying to turn up, which means for that to happen, we have to start trading above that level right now. See if I have it on screen. That's 19,200. So that we need to stay above that level. We're trading right at it right now. but we need to get above and stay above that level. I believe these little red dots that are up here will start to move a little bit higher here. But we're looking at a zone here where we're going to come up once again into that distribution level. If we get above the distribution level, then it's Katie bar the door. We're going to see a big push back up towards the all-time highs. So guess what? If that's going to happen, you got to go back to another thing, which would be you got to believe, NVIDIA is going to do the same thing. Matter of fact, let me just bring that up. I tried to bring it up yesterday, but look, you can see a similar pattern. The patterns are identical because all of a sudden this has been the primary sentiment stock here. So folks want to talk that it's not doing what it's doing, which is a leader of this tech sector right now. Everything else is going to pile in behind it. The Mag 7, no one talks about it anymore. You don't see it on comments. Maybe some folks are talking about it, but you don't see it around. It was like the thing 6 months ago. That's all you talked about, right? Mag 7, markets being driven by 7 stocks. And I've shown you folks in the Russell and my ETF hack that I picked 12 stocks that way outperformed the Mag 7. Okay, so it's about stock selection. And folks that do this, I saw a guy talking about how the Russells outperformed the S&P, which was funny. He went back to like July 24th, and he shows 2 charts how it's outperformed. Year over year, of course, it's not. As a matter of fact, the S&P has kind of taken the lead on the upside again, and the Russell's 10% off of outperforming. But this is the other thing that I'm kind of going back to my opening comments, is there's folks that want to build these dialogues and these narratives, and they build on them, like Tom Lee and talking about how the Russell is going to double. Maybe it will. He could be right in 2 years. I can't trade 2 years out. I can only trade right now. So you can put those trades on. If you have a lot of money and other people's money like Tom has, maybe you can do that. So that is the point. So anyway, staying in you folks have heard this before. I always look at trading like being on an old dark country road with the bright lights on the car and there's no moon out. So you can only see the next corner. So we're always looking for this next curve to come up and evaluating what are the possibilities of this next curve. Is it a critical curve, and if you're not careful, or is it a cliff? It could be driving off a cliff. It was pretty much a cliff on NVIDIA when we hit those top ranges. But anyway, this stock's being has the same formation as the NASDAQ and the S&P. Why? Because it's a big driver of the sentiment right now. So expect to see this stock come up. We have all the same challenges on every chart I've shown you so far tonight, is that there's a distribution level that we did a couple weeks ago. That's going to be formidable, and maybe we can get Fed news, something like that, and everything will just magically go through. Most likely will be a lot of resistance. The algos are, like I said here, looking at this, I could still have the NASDAQ up. It looks the same way. Let's go back to the NASDAQ. I'll show you. So the NASDAQ has this same formation. In fact, NVIDIA is a little stronger on this PPM1. I'll go back to ES for a second here just to show you all these formations of the forecast of what's likely to happen is there, and that's telling us that we're likely to go in the same pattern. They all have the same patterns. Okay, so speaking of Russell, let's do Russell. Like I said, I'm just going to go mad scientist on you guys and just go through here. So Russell went back to hovering around its 200-day moving average. It has that distribution. It has a second distribution point. This as I've talked about a lot, is this this asset class has got all kinds of problems. I know. I listen. I love the small cap trade. That's the rotation that anybody my age or even a little younger talks about. This is the natural rotation of the markets within a bull market, and ultimately we get the small cap run, and then that's the end of the phase, and then we go and reset and do all that. I know that. I've lived through multiple events like that. But what we're seeing here is this is just still locked in. I'm gonna bring this out, and this brings in a pretty big perspective here. Let me fix this scaling. But this is going back to 21. All we've done is we corrected. Now we're coming back in. This was the previous monster right here. Let me move this around. This area right here is nothing more than another distribution level, and we got right into that distribution. There's so much here for this market to be able to work through. Not to mention, not one drop in interest rates is necessary to get this market moving, but multiple drops. And I won't go through. I think it was just a couple of days ago I went through the entire interest rate spectrum talking about the yield curve. Go back 2 videos ago. I think somebody mentioned 3 days in a row. It's like the old days. And but the bottom line is here what we're seeing is this is a mess. This is not this is going back to what 2018. This is the futures. So if I went to RUT, we can get a bit further back here. Now you can see this at a next level. But this area where my cursor is right now, this massive distribution, and we're possibly setting up another distribution level. And if I bring up the algos, I can't get the forecast. I'd have to change too many numbers. I'd have to change the coefficient to get here. But just looking at things in general, we have bullish upward pressure here, and there is a upward bias. This is long term, but there's still so many challenges. My prediction is mid 2025. Maybe that's when we finally see the rates. If you go back and watch that video I did a couple of days ago, I won't go through it tonight, but that is, we need to see the yield curve. We need the front end of the yield curve to be around 3%. It's currently at 5.25 to 5.5. I think the effective Fed funds is 5.33. So what we need is all of this to get back into a more normal steepener curve where you have the front end of the curve, not just the 2-year is somewhat insignificant in the big scheme of things. I always call that a very retail number that people watch. The 2-year is pretty irrelevant. If you're running a bank, you're not that worried about the 2-year asset class. Okay, you're more worried about the short end and the back end and how you're balancing where your maturity of your book is and all of that stuff. That's where you're concerned about running that big book of business. And running a bank is a big deal. And it's not just about there's so many assets that you have to watch. But the point is that the yield curve starts at the front end, which is the Fed funds overnight borrowing, and then getting into 3 months, 6 months out to all the T-bill section. That is a very important part. When that is down into 3 handle, everything will be better. I still think that even though we're seeing some downward pressure here on the 30-year, that on the 10 down into the 360 range, that's fine, but it won't stay there. As this thing inverts, you're going to see, I believe, the back end will be even a flat line or slightly higher, maybe 1%. A typical spread on that spread is 1.5 or something like that. But that is what's necessary for this asset class to come alive. Now, maybe you can get ahead of it a little bit, but this is not for me, it's not the kind of pattern. I'm just going to back up for a second here. We're going to go to a weekly chart and see if I can get this to refresh here a little bit. Yeah, so This is a sloppy pattern. This is not a trending pattern. This is lots of noise, and there's it's not the kind of pattern where you're going to typically break out of. We do have some upward fib targets that are suggesting 23, 2400. I'm just looking over here, 2417, 2489. That's up where my cursor is above. There's some small dots. I don't know how visible they are out there on your screens, but this is pretty much there. Yeah, I think if they did 50 points, that would be a warning that there's something broken, and I don't think they'll do that. They're going to be um, way more restricted than that. Okay, so let's do this. I'm going to bring up the 10-year for a second because I think this is the weekly 10-year. So we're going to the treasuries now, and we've had this big downturn here. This is weekly. Let's take a look at the algos. Are suggesting that we're probably going to bottom here. We should come back into the moving averages. That right now, that's going to put us around, let me just get some numbers for you, around 390 to 395. We should go back into that range. I don't think we're just going all the way down to the 200. We have no Fibonacci targets. We don't have any patterns that are emerging. We do have weaker patterns from the algo standpoint for another, this is weekly for another couple weeks, but then it looks like it wants to stabilize, and I don't think we get much below 360. We could, anything's possible, but like I always say, the market's about probabilities, not, there is no certains in the market. So you can see here we've had a number of things that are just really a really nice downtrend since we peaked out. We came right into these fib targets up here. We got into fib target 2, which was just looking here, 478. We printed up at, what was the high in there? The high was 473. So we came right to fib target 2, and then we've been down ever since. And so my point is, I went through a lot of yield curve. I just wanted to tie it together. I think this market is actually going to start to bottom here from the way I can see it. Yeah. So okay, let's move on. Let's go. Let's see here from interest. Let's go to gold. I thought that was interesting. I was just talking about this pattern just a couple of days ago. We did blast up to we came right up to the RXT level, 2579. We got to 2588. What I'll show you here is we go to a daily. We got what's called an RXT sell signal. Right here, we closed above the outer bounds of this, and you can see. Let's see if I can blow this up so I can draw in these patterns. But this is pretty typical pattern, and usually the market comes back in. There's definitely some bullish configuration here. Angle of attack and moving averages have a bias to the upside. We do also have some fib targets on the upside as well. So let's break this down as fast as I can here. So what we're looking at, the algos are suggesting we're going to stay above this 10-week moving average. That currently is 25.45. We closed above the RXT 25.63. The close, this is a daily, so yesterday the close earlier was today at 25.87. So what that tells you is we get 1 to 2 days of sideways movement. So let me show you a couple of these events that are right on the screen right here. Let me see if this will go away. Yeah, so if we come over here, you'll see here's one. We got 1 day sideways, resume the trend. Here's another one We got 2 days flat and then move down. And there's another one right here and another one here. Every time we get these little flats. And we haven't had anything. Now we've got one here. We should get some kind of flat. Market grid should probably come in like this a little bit, but we'll stay above this trend mode here. The PPM, I don't have it on screen. I'll bring it up here in a second, but the PPM 1 and 2 are both in trend mode right now. So we definitely have strong trends up here, but we're not seeing any of the anything that would suggest there's going to be any decline. What I talked about the other day is I thought we'd stay sideways. We got this big breakout, so this is probably an easier market, I would say, to actually come in and maybe manipulate. It's a reasonably liquid market, but it's not that liquid. And they had a stampede in there. Everybody goes, oh, rates are going to go down. It's going to be good for gold. And that is to a point. And we'll see what kind of competition gold has. But that story's been played out pretty good. We also, I'll just punch over here to a monthly chart real quick. And this brings in some perspective here. So monthly projections are very bullish. I mean, we're looking at, if we go all the way at 2,700, and those are big numbers. And I remember talking about these fib targets here on a monthly going back. They were suggesting 2578 was the fib target 3. We've just hit that. So we've satisfied the fib target, but the angle of attack that we're seeing here, so those of you that are new around the channel, what this angle of attack is, these moving averages have probabilities when they are at these different angles. And this is a very steep, telling you that a small probability of getting below the 10. And you can see even the algo forecast is for the markets to stay above that 10-period moving average as we go forward. And this is monthly, so this is long term. But we did satisfy these upward projections, and depending on what kind of configuration we get, we're early on in September here, so we've got better part of the month to go. So we'll see how this plays out, whether we pull back from here, if we finish higher or not. It's very easy to this market to give back what it's done so far. But okay, so let's I think I'm doing pretty good. Yeah, 42 minutes. So what I'll do is I'm just going to go ahead. We're going to cover Bitcoin, and then we'll go back. Yeah, so somebody's asking buy or sell gold. We've been long gold for a while, and I would say it's still a hold. And yeah, you just want you should have lots of these laying around. Okay, so I think gold's a good long-term investment, and it's pretty solid. And the trends that are in play, that's why I showed the monthly chart here. It's just very strong. And these charts, by the way, forecast out. That's 20 March 26 out here. So the forecast is for us to stay above this trend, which is the 10-month moving average. That's going to stay. We should stay above it. What I've been arguing for is maybe some consolidation here, but we keep getting these little blips into ATH all-time new highs, and we just keep going down this level. So I wouldn't be looking to sell it. I would play along this trend, and we should say things go all the way. Yeah, so I'm glad somebody just said something. Let's go from here. Let's do a quick look at crude, and then we'll do Bitcoin. So let's do that. Just going to leave this monthly chart up here since I've got it. This was something I did discuss. I covered the other day, is that we've got the STX level, which is the extreme downside level, was 64.03. We got down to 65.27 on a monthly basis. And I think and when we look at the algos, they're suggesting kind of stability, but there's still some downward pressure. There's some downward uh, Fib targets down here at 60, 30, 49.90, and 43.47. I remember mentioning these the other day. I don't think those are very realistic, but those are where the pattern would lead us. And if that happens, then there's something else wrong. And then the whole I would say what would be wrong was there would be a lack of demand for oil, and that would be maybe a recessionary event that would have to happen to get to certainly into the 40 handle. I don't see that happening. I do see the algos are suggesting that we're probably going to, I'm just looking at this 200, that but when we come into the first of next year, we could see that go. But who knows? Maybe in January will be drill, baby, drill. Who knows? So we'll find out, and that maybe it's not even impact. It's just more supply, and everything's positive. So we'll see how it goes from there. All right. So yeah, let me go to a weekly, and then we'll move on to Bitcoin, and then looks like I'm running pretty good on time here. So this is crude weekly. Looks like we're starting to get a reversal, but this is where a lot of times when you look at the monthly charts, they move like molasses. They're such big noise. So when I'm doing my streams and when I'm doing analysis, I like to do different time series. So one of the things, if you do a 5-minute chart, you have lots of noise. You go to an hourly, the noise starts to condense, meaning the bars start to condense over time, daily, weekly, monthly. So what you get, there's a time series. When you're looking at a weekly chart like this is typically where you're going to be able to best find the emerging trends or trends that are ending. These charts, weekly is, for me, the intermediate is one of the best. And I'll start intermediate daily, maybe go into hourly or intraday if I'm trading that particular thing. But from the standpoint of what we're looking at here, this is, you can see the forecast here. Forecast is for a bottom and moving back up into, the 80 handle at some stage. I don't put a lot of confidence in this back end, but I do see us getting back into these moving averages. The algos are all projecting like really positive trend coming up. And I would suspect that at these levels, 60, 65 bucks, that's the case. Who knows? I don't know if they're going to replenish the reserve or not, but this would be one of those times to maybe be buying some oil. If they did that, I'd be really impressed. But the bottom line is, it looks like crude oil is going to bounce. So I'm going to argue that this is more of a potential view of what's likely to happen from a macro viewpoint of the economy, that things aren't going to get really bad. Okay, we don't have a collapse coming. I've been the guy for a year and a half screaming there's not going to be a recession. So whether you call it soft landing, whatever you want to call it, I think possibly, and I'll just put this in at this point in time. I think possibly we're looking at maybe seeing that the Fed, in hindsight, all the criticism they've taken, they've walked the line, and they actually did a really good job. I've given them a number of times in the last year an A, at least a B plus to an A. They basically have done everything right. They've stayed the course, and nothing's crashed, and employment has gone up a little bit, but nothing drastic. All this stuff has definitely been engineered really, really well. And I think part of that goes to even my scenario that I was talking to you folks about earlier in this broadcast, is that the metrics that we all have, including the Fed and those folks, are really, the technology is helping everybody to guide through these financial times. So it's, I think it's fascinating. I've grown up in a world when we were used to do charts for the markets. We had to do them by hand. We used to have a thing, I'm trying to remember this thing, it was called, I'm spacing out the name, but it was a big booklet, and they would send every week. They would send you new charts, and guys would sit around in the office and replace all the charts on the stocks, take the old one out, or we put the new ones in, and you could thumb through multiple weeks of charts. So that's how you used to get information on a piece of paper. Now, like I said, we got the digital ages here and the ability which to move very quickly. All right, so let's do Bitcoin. I'll show you the daily in last night's Substack I was talking about. Looks like we're going to rally. We're trying to get back in this pattern. So once again, this is one of those distribution patterns, and this has got a big issue. And I'll just touch on this for a minute. I wrote about it somewhat, somewhat in length in the Substack a number of days ago. But since they have an event and since all these ETFs were approved and come in, we've seen this pattern. And I say, unfortunately for Bitcoin and crypto, you let the bad guys in. And the bad guys are all the arbitrageurs, the guys that run these funds, and they see all the opportunity just to be scalping on and taking, basically spreads on all of the stuff and the cash flow and all that stuff. And this is what it looks like when you get there. There's going to have to be, I don't know what's going to cause us to get out of here. My concern with Bitcoin longer term is that if this distribution continues, then we have to go to the 200-week moving average. That's 38,000. I don't think we're going to do that, but we are seeing this consolidation. I think it's more of a distribution that's going on. I think there's a lot of new players in Bitcoin that weren't there before that have bought these ETFs. And if you look at the volume on these ETFs, it's insane. And so there's a lot of money around these things. And the ARBs are there, the market makers are there, the guys in the funds are getting all the opportunity and cash flow to make to do well. So there's a lot of folks playing off of this market. And I think that's why we're seeing this pattern. But even the algos here, this is a weekly, is projecting a slightly higher price. Let me put this over onto a daily. Daily, this is what I've been talking about, and daily is we're seeing the algo starting to turn up. We're also seeing that we've got fib targets coming in. The 200-day is right here. I think we easily could get up to there, which is around the 64,000 level. I think we're going to rise up above these averages. We're at least going to get into this zone up here, and that should be, I think this forecast that you're seeing on the screen right now are pretty accurate on what we're likely to see. We're going to see a general bias. We should flow up along the 10-period moving average. It was looking pretty crazy the other day. It looked like we were going to get a print and break out some numbers. It didn't happen. We did get down here, to 52.5. This, if I bring this up here, this low over here was at, I believe it was 49,500. Yeah, 49,577. That's your key low in this pattern. We got a big rally off of that, come back. This was, in my opinion, probably be considered to be a retest, but more consolidation. And the best case is maybe get up the fib target 2 here, which is 64.9, 200, 64,000 roughly. And then we probably trade in between where we are right now, between 58,000 and 64,000. So I don't think anything exciting, but I think we've got at least a stable market coming ahead. All right, so let me look at some comments here, and we can see if there's anything I can touch on. We got about 5 or 6 minutes we can go. So I appreciate everybody coming today. Let's see here. Yeah, so far somebody goes, can't go wrong holding gold. I agree. I've always had some around. Yeah, so hey, Bo. yeah, he was saying, can we look at the small cap ETF that I hacked? If so, what is it named? It's not available to the public. It's under my name. Um, I should make it a premier so you could find it. But it's easy to rebuild. So let's let's put it on screen here. So I'll go over to WaveTech. Let me bring it up. So on, I'll go over to WaveTech. We'll go to Portfolio Manager. So what I did, folks, for you, if you haven't seen this, is I went in and I went into the IWM, and right here, IWM Dynamic Dozen, I called it. And this right here is the returns of you can see right above me here. I can't move this around very good. Bear with me a second. I want to try to build this up just a little different. There we go. Still getting used to the Mac. Okay, so this right here is the equity curve, and if I look at the down below here, and the last from 2021, it did a 24% return, 16%, 50% in 23, and up 40.48. It was up about 44%, so it's pulled back in this most recent pullback. But this is what the equity curve looks like. And one of the things that is typical within a strategy within WaveTech, if you're managing money, is if you do all the trades as instructed, size-wise, timing-wise, all that, you see stair-stepping equity. Very seldom do you see a high where a previous low is taken out. It's just literally a stair-stepping pattern that happens. So let's take a look. And here's here's the stocks that are in there. So you can take a look there. These are all the stocks that are in there. So I'll leave that on the screen. So worst case on a replay, you could pause it and take down these stocks. But this is everything that's in there. Probably update this maybe at year end. Take a review. But these were the 12 stocks that I picked. This is the current summary of what's in there. So this is open positions right now. And these are the P&Ls. This is when this is the entry date. So some of these November. This one's been on for a while. It's up 446%. This was back in January of 23. Here's a June this year. Here's a March, another July. That was July 23, so over a little bit over a year ago. These are big returns. So these stocks are mostly looking for exits at the moment. So it's yeah. So anyway, that's what that looks like. Okay, I think we're getting close to the end here, folks. We're right at 1 hour, so I try to keep these to 1 hour. And yeah, hit the like button, do all that good stuff. I would tell you that it's going to be an interesting week. I will discuss what I think about what's going to happen in the Substack. Those of you watching, kindlereport.substack.com. It's $8 a month for the newsletter. If you do an annual, I think it comes down to $6.50. You can't go to Starbucks for that. So, but anyway, get that. I do all my macro analysis later tonight. I will write up a lot of thoughts on these markets and things. And I've been able recently to get online here a little more than I have been. So that's been good. Yeah. Yeah, don't get too excited about these. I see some comments, 50% drop. That's not bullish. Okay, it really isn't. You don't want to do too much too fast because that shocks the banking system. It really screws up. There's what most people don't realize of what these rates really mean. I don't think they have some perception. I worked with very 36 of the largest banks used to be consulting clients of mine. I worked with primarily with their portfolio management and the real portfolios, the bank portfolios, and a lot of the proprietary rooms. So I can tell you, I've been behind the curtain. I've been an institutional trader, and I can tell you there's a lot more to it. 50 might sound good to you, but 50 would not be good. That would be a shockwave in the banking system. You got to do. That's why the Fed does it incrementally, especially on the stuff that they're fixing. What you can watch though, and you get some feel, is watch how the 6-month, 13-week T-bills and some of the 1-year stuff. Look at how those are trading. Don't forget that 2-year thing. That's too amateur. But look at that range there and watch it. The 5, 7, 10s, 30 is pretty much fixed. I think I have it up, so I'm going to show you something real quick before we go. But this is what the red line is what the yield curve looked like in January. The blue line is where it is today. So we've actually, from a yield standpoint, we've moved down. So these are forecasted in here, and you can kind of see a shaded area here. This is where the current fixed rate is of that effective Fed funds at 533. So this is where things are fixed. They're going to move this fixed down gradually, 5, 4 3/4. They're going to go tick by tick, just like they went up. What I'm trying to say here is if you move anything too fast, especially on the front end of the curve, it up or down, okay, can really disrupt the banking system. The Fed's more worried about the banking system. They're not really worried about the equity market since we're trading within 2% of the highs or less. So no one's worried about equities. No, that's not what the Fed doesn't care. There are times when people, the plunge team and all that, having worked behind the curtain, you don't want to move these things too quick, up or down. Those are dressed 50 bip. You can look at how many times they've done it. Not a lot. And that's only in the past when it's happened is when the market rates have moved so much the Fed was adjusting to the rates. The Fed doesn't want to lead rates. They want to adjust to rates. And I've been arguing probably since we started in this last Fed cycle of hikes that what we're really going to see here is the Fed the tail doesn't want to wag the dog anymore. They're going to let the dog wag the tail, meaning that the market forces will drive rates down and then the Fed will adjust to it. That's how it used to work. It wasn't until really Ben Bernanke started this helicopter Ben was the one that started all of that stuff. So from that standpoint, you just so you understand, if they do that, there's something really wrong, and they know why they're doing it. I don't think there's any reason to be drastic like that, and I don't see the signs of that. And I've seen a lot of dislocated capital going back to '08, but even going back in 1979 was a perfect example when Volcker came in. So I won't go through. I actually want to do a video. I've been working on some content that I would like to produce and kind of go through the history of some of these things. I think it would be a really good lesson to do, and I need to do that. I think I just decided that I definitely need to do that because there's some history with the Federal Reserve, especially going back to around 1950 up to 1970, and talk about some timelines and things that have occurred that have changed how the banks act, and how the bank acts to the banks, otherwise the Fed to the banking system. And I believe that Powell is trying to go back to a predecessor of his many, many years ago, and he doesn't want to be in that micromanaging of the economy. They want the economy to manage itself, and it's certainly capable with all the tools and the conversation that we've had in tonight's video. Anyway, so we'll call it quits. Appreciate it. I will, we'll see. I don't think I'm going to do anything Sunday night, so go to Substack, get the Substack newsletter, KendallReport.substack. Don't have the indicators, get those. That's KendallReport.com/indicators. We've actually got an announcement, hopefully on Monday of next week, we'll be able to make this. I'm pretty excited about this. I think a lot of folks are going to benefit from that. Anyway, we'll talk to you soon. Thanks for watching. Have a great weekend and have a good day trading tomorrow. See you later.